Hello, and welcome back to the Lobster Talks podcast, where YC founders tell you about their story, about what they went through, about what you can learn from them. And today we have a fascinating story. I specifically asked Jason to be here because he's going to talk to us about opportunity cost and pivoting, my favorite topic. So I'm very excited to get Jason Fan, the founder of Finic. Jason, thank you so much for being here.
No problem. Thanks.
All right, let's jump in. Could you give us a brief introduction about yourself and about what Finic does now? But of course, we're going to dive into the whole story in a minute.
Sure. Yeah, my name is Jason. I'm the co-founder and CEO at Finic. What Finic does is we are an AI risk ops automation platform. So we help fintechs, institutions, so banks, credit unions, and like startups automate a lot of their risk operations. A lot of people don't really know what risk operations mean when they hear it. It's like very vague. It's what is risk and how do you operationalize and then automate that. But that risk operations usually falls into a few different buckets. I won't go into all of them in detail, but the ones we focus on are specifically fraud and disputes. Those are the two that we focus on. The reason we focus on those is because my background is in trust and safety. And so before Finnic, I worked at Robinhood on the trust and safety team. And it was actually part of my responsibility to build out all of the fraud platform and tooling for the operational team there. So there was a team of a couple of hundred agents that were just investigating fraud cases basically on a constant basis. And before I joined, they were just doing it very ad hoc, pulling some data from this dashboard that was actually built for the customer success team, and then running some queries, and then pulling some other data from their data sources that they had. It was just taking a really long time to investigate cases. And when I was there, I built an investigations platform to centralize all that data. And by the time I left, we had migrated the case volume that Robinhood looks at that used to all be in Jira as like the case management system. We took it from 0% to 100% of the cases being investigated through the platform that we built. And so even to this day, 100% of Robinhood's fraud and a lot of their even like non-fraud, like money laundering cases as well, go through that platform. So that's on the order of tens of thousands of cases per month. And so we sort of fit it from the inside that, hey, like this was super valuable for Robinhood, but we had to build it in-house. There actually wasn't a solution like that on the market at the time. And so we're building Finic to both be that solution, but also be a much better version of it. Because the thing that you can do now that you couldn't back when I was a Robinhood is you have generative AI that can do a lot of the subjective reasoning work that used to require humans. So for Robinhood, for example, we had analysts that were being paid on average $40,000 per year, mostly offshore too. The analysts were paid, and then the consulting company like Cognizant or Accenture would take their cut. And then by the time that Robinhood was actually paying for it, it was 40 something thousand dollars per year. And so it was just a huge cost center for the business. And with AI, you can finally place a lot of those offshore agents and disintermediate all of those like legacy consulting firms and just automate a lot of that work with AI. And so that's the second portion of Finic and what we're building today.
Wow, no, that's awesome, man. So there's several directions we can go with that. We can go with AI allowing to actually replace jobs. So I'm going to table that for a minute.
Sure.
And then we can also go about, we see many YC founders, and I've invested in some who come from, I would call it big tech. We see a lot of ex Google, Meta, Robinhood is a very good example as well. And there's a fair amount of ex Robinhood at YC, and you
Mhm.
build something in house that's really valuable. And then the jump is pretty obvious. Oh, if Robinhood needed that, I'm sure there's other companies who need that. And you do that with ex people from Uber at YC, from so many different companies. So that's also absolutely fascinating and a great way to build a company for entrepreneurs out there.
For
If you go
sure.
get a job at a big tech company, build something valuable in house, then you can potentially go out and replicate that. Let's potentially table that as well if we want to come back to it. But I would love for you to tell me the history of what happened and how you pivoted to be here. Something that my fund, Lobster Capital, only invests in YC. And a lot of
Mhm.
people ask me, why did you choose to do that? And the basic answer, what it comes down to is opportunity cost. When I'm
Yeah.
investing outside of YC, not invested in YC, you don't have infinite numbers. And so that's something that you've clearly understood extremely well throughout your story and what happened in Phoenix. So could you tell me or tell us actually the story of what happened there?
Yeah, for sure. I actually first decided to start a company. The company started in like at the very start of 2023. And so when we applied to YC, I had just quit my job at Robinhood. I was actually just taking more of a post-winter vacation, traveling to different places. I'm going to Mexico, Singapore, a lot of other places as well. But it wasn't until we applied and got into YC that I really considered myself, a founder. Because my co-founder at the time hadn't even quit his job yet. He actually left Robinhood to join another company, Point Tracker. And we were just like hacking out some projects on the side, but it didn't really feel real until we actually got on YC. And then so January, when we started, we actually didn't go in with this idea at all. There were a bunch of reasons for that, but at the time, looking back on my experience with Robinhood, it wasn't obvious that the thing that I had built there could actually be productized. Because without generative AI, if you wanted to go and build like a fraud investigations tool or even a case management system, you basically had to build it custom for every company. Because the way that every company handles fraud and what they consider to be fraud will vary from company to company. I think that's changed a lot since then. At the time, this wasn't one of the ideas that we were evaluating. And so when we went through YC, we actually went through a bunch of different ideas. And ultimately, even after the batch, we landed on the idea that we'd end up working on for about a year and a half, which is DealWise. And that came about after we had a few conversations with people, just really just in the idea maze, like looking for different problems that we could solve, who were what were called searchers. They're people who went through an MBA program and then raised a few $1 million to acquire a small business and then operate it profitably for the next few years with a goal of basically selling it or continuing to draw off cash flows and becoming a millionaire. And so for a lot of MBA students, the path is often either you work at a corporation, you work in finance, or you become a searcher. You go and raise money in a PR company. And so a lot of Harvard grads, Stanford grads were taking this route, particularly in 2023. And we realized, yeah, there just wasn't a very good way for those people to find companies. And we went through a few iterations of DOIs, eventually landed on a model where we were basically helping different companies get acquired. In some cases through searchers, but not necessarily. And through that process, we also realized there was just massive lean demand for what we were doing. Like it was not at all hard to find founders or small business owners who are looking to sell their company. I think two things were driving that. One is like a downturn in the economy means a lot of like founders were seeing their growth slow. And then they're now considering, okay, I've worked on this for several years. Do I want to continue working on this when it's not like hitting the milestones I wanted to? And the second driver of it was Gen X was retiring. Like the average age of Gen X is about 60, I think it was in the low to mid 60s. And so that's a perfect age if you're, especially if you're a business owner, to start thinking about retirement. And so as a result, we were just able to very quickly find a lot of customers who wanted to get their companies acquired. And so that's what we were working on for about a year and a half. We got to about 150,000 in revenue for that year, just doing that before we decided to pivot and shut down DealWise and start Finic instead. So I can talk a bit more about that. But
Sorry to interrupt you.
sure.
I want to double click on something because for me, that's the main reason I want to be on the show. You worked on it for 18 months. Okay. There's so
Yeah.
many stories of people who pivot inside YC after 2 weeks, after 1 month. You're really committed to the idea. A year and a half is a really long time. That's one thing I wanted to double click. The second thing I want to mention is you did 150K, not like you did $2,000. Because if you do $2,000, it's pretty obvious you got to pivot. You're
Yeah.
actually doing substantial. Obviously, you want to do much, much more, millions and then tens of millions and then hopefully hundreds of millions. But doing 150K is no small feat. There's a lot of founders in YC and who would dream to do such revenue. So just wanted to, mention that it makes the rest of the story even more interesting and impressive in my opinion. So please keep going, but you're doing well at the time.
Yeah, exactly. It was like a weird zone where we were making revenue. We could see a clear path towards making more revenue. And that's the dangerous part, right? I think the reason why a lot of founders take so long to pivot is not because everything is failing, everything is going poorly. You can't find a single customer. Pivoting is a pretty easy decision. It's really tough when you have some customers, some who are actually like are very working very closely with you, actually making revenue, and you know how you can get more revenue. In those cases, it's very easy to just tell yourself, yeah, this is scalable, it's repeatable. I can keep doing this and we'll be a billion dollar company one day. And frankly, probably for the last 6 months, that is what we fooled ourselves into thinking. But yeah, it was like a not insignificant amount of revenue. I'd say the key catalyst for that was actually YC. So at the time, we were already starting to feel a little bit like we weren't really sure where this was going to go from product standpoint. So We started out deal wise building a marketplace. The thesis was if you just build a marketplace, there's so many buyers out there and so many sellers. The problem is they just don't know each other. If you're a small business owner, you probably don't know a single private equity investor. Or if you're a startup founder, some VCs, you also probably don't know any private equity investors or searchers or MBA students. So we built a marketplace, launched it. That actually did like remarkably well. We had YC, we posted on LinkedIn. It was like the top post of the week or something. We had like thousands of people signing up in the first week. And there was actually a lot of activity. We built out like a messaging platform. We built out all the stuff so people could actually message each other and connected. And we probably facilitated hundreds of connections through that marketplace. Then we realized the problem was, well, how do we get paid for the service that we're offering? And that became the really difficult part because once people start connecting on your platform, right, you have no idea where the conversation is going, what's going on. They have no reason to include you in the conversation. They take it off platform. We know of at least one company that got acquired through our platform. There possibly were more, but we know of at least one. And we just couldn't get paid for that deal. Like it just didn't happen. And so after that experience, we realized, okay, so in order to actually get paid, we have to stick close to the seller. Just make sure we're integrated into every part of that process. This is a tangent, but that's why a lot of people, these business brokers or investment bankers are really annoying because they're just like always up there in your face all the time, trying to do everything for you. And part of that is probably because they want to provide a good customer experience or good client experience. But probably the bigger reason is they need to get paid and they know they're not going to get paid if you're not thinking about them and they're not perceived as adding value to the process. So through that experience, we realized, okay, so we need to stick close to the customer. We ended up just being brokers ourselves and doing a lot of the legwork ourselves. That involves collecting the financial statements from the sellers, fixing their financial statements when really wasn't clean. And most businesses don't have very good financial statements. It involved marketing the deal, creating marketing assets for it, finding places to distribute them, answering questions from buyers. So all the work you typically associate with a business broker or on the upper end of the market with investment bank. And that worked out a lot better. We were able to get paid for deals when they close, but also importantly, we were able to get paid retainer from some sellers who were more motivated to sell. That was a few thousand a month. And so that to us seemed, oh, this is great. We can get paid in two ways. Sure, it's not repeatable because when someone sells, they're not going to be a recurring customer, but you get paid a decent amount on the front end, and then you get paid a lot on the back end if the deal goes through. Once we did our first deal under that model, we already started thinking, hey, like this is something feels weird here. And the thing that felt weird was we were spending no time at all writing code. And so even though both of us, our background was engineering, we were just like talking to customers all day, which is great. But I think to have a real startup, you had to talk to customers, be building shipping product. But we were only talking to customers. That made us feel, are we really in the business of building technology or are we actually just a broker? And so we scheduled a office hour with our YC Group partner, Dalton. And on the call, Dalton was very upfront. He told us, hey, like we were actually excited because we're like, hey, we have revenue. We're like growing. This is great. What should we do next? He was just very upfront with us and said, hey, you guys are building a service company. You're not building a startup. This is not going to be a $1 billion business. And we tried to debate with him. We're like, we can make it AI enabled. We can make it a tech enabled service like pilot.com and other companies that are building tech enabled services. And you can scale that way because pilot.com raised $300 million of venture capital. And Dalton was straight up, that's not going to work. And then later on, we found out because I have a friend who was an early employee at Pilot that, yeah, they raised a lot of venture capital, but because of their business model, they're really not generating venture capital scale returns. That's been a challenge for them. And so we realized, okay, so the other companies have tried this model, have failed. What is going to be different about our company? That means we're going to see a venture scale outcome. And we couldn't come up with anything. After about a month of deliberations, we're like, okay, so clearly this might still double year over year. But if we did the math on that and it just doubled year over year, like it was never going to be a venture scale outcome. And so that was at that point that we made the difficult decision to just shut it down, basically throw away all the work that we had over last year, offboard all our customers. And we didn't have any idea at the time of what we would go for next. We just did that first and then spend the next, I want to say 3 months going back to the idea maze to figure out like what we should build before we landed on Finic. When we did, it was clear that we should focus on this because we just had a much better story to tell about why we're working on it than any other idea because we'd already done it.
So many fascinating points. Thank you so much for going through the story. I did want to ask you what YC said and Dalton said.
Yeah.
You've covered that. I could hear Dalton I can hear his voice being like, nope, guys, I'm telling you, it's not going to work. Like that's typical.
Yeah,
And
exactly.
that's what you want. It's the tough love. You want the truth. You don't want people to mind your feelings. You want them to tell you.
Exactly. And Dalton is particularly, if you talk to Dalton enough, you notice he's pretty chill as far as YC partners go. Like some partners I've heard anecdotally will just tell you what you should do. They'll be like, this is what you should do. This is not going to work. This is X. This is Y. Dalton is not like that. He basically just asks, what do you think? Do you think this is going to work? Which is why it was so jarring when this was the only time he just straight up told us, no, this is not going to work. You guys should pivot. This is bad. And then because it was so unlike how he normally operates, it really made us take it seriously.
That's great. So he has a whole repertoire, levels of intensity that he can pull off for you to really understand the point. So that's amazing. And again, we come back to those amazing group partners at YC who've done it before, who have the experience and who've also worked with hundreds, if not thousands of startups. So they've seen a lot of things. And so this is just another part of how invaluable YC is. So I wanted to ask you two things, but what's really interesting is without a single idea, you started right away by saying we're going to shut everything down, and then only you were thinking about the future, which is probably counterintuitive. So why did you choose to do that? Not just let's take 3 months and think about the new thing, but still make revenue on the side at the same time. Why did you just shut down right away?
I think if we had built a SaaS company, that's probably what we would have done. I know a few founders where that's exactly what they did. They kept their existing product basically in maintenance mode, just provided bare minimum support, and that's it. But since DealWise was more a service company, we couldn't actually do that. And so it was a decision between we're still going to have to dedicate like 60 to 80% of our time with our customers and spend like 20 to 40% figuring out the thing we're actually going to work on, or we just shut it down. And so it was a pretty easy decision to make. If we had a SaaS company that was making 100K or 200K a year, that would have been a much more difficult decision. We probably would have just kept that going and then drawn off that revenue. But with a service business, it's entirely different.
It's 60. Oh, sorry. Go ahead. No, go
Yeah,
ahead.
so that part wasn't too difficult to decide. The other part of it was we did raise a pre-seed round even after YCs. And I think this was actually, it's probably isn't necessarily a good thing, but it's probably one of the things I'm proud of the most because at the end of YC, we still hadn't figured out the idea for DealWise. We were still in the idea maze, but we still managed to raise another 700K from investors because it felt like 500K wasn't really quite enough to get us to the point of figuring out the right idea and then also going to the next thing. And so there was one thing we were already working on that we had customers for, but it was already clear to us at that point that we were unsure if there was actually going to be a market for it. And so we had enough cash in the bank left over to make us comfortable with not having revenue for a while we figured out the next move.
Yeah, that's pretty bold move and pretty strong, but it's working out for you. We should talk about what happened since, and it is working out for you. So that's absolutely amazing. Just a final question on that very specific, important moment. How did you feel? What were you and your co-founder feeling? Were you scared? Were you mad? What goes through your head? Because I'm guessing there's some founders listening here who are they're thinking two things. One, if I'm making 150K, no way I'm pivoting. Or they're thinking, I should also pivot. I have 100 or 200K of revenue or 50K, but I'm feeling a bunch of stuff in my mind, in my head. I'm not sure if I should pivot. So what were you feeling at the time?
Yeah, I think it was a mix of things. Initially, I think that the first big hit was actually the ego hit because when we were working on DealWise, there was at least a perception that we were doing quite well. And that was a perception a lot of our peers had because our posts on LinkedIn would get a lot of reactions. There would be people commenting on the post being like, oh, let's talk. I need this. And so it was, I think, clear. It was visible from the outside. A lot of people needed what we were doing, even if the business model didn't really make sense for like a venture scale company. There are a lot of business brokers and small businesses that do this kind of brokerage work that make decent. So I think the ego hit was the first one where I thought Man, I have to go back to basically being a brand new founder all over again with very little to show for it. And that was just exhausting. But I think that only lasted for about a week or so until we realized, hey, it's good that we realize this now. There's something much higher potential that we could be going after that's not this. And we are in a pretty privileged position of having a lot of cash in the bank, of not having to really worry about fundraising for the idea and just being able to go find something. And that's compared to other founders who are entering the idea maze at the start, that's a much better position to be in. And so I think we were in a pretty privileged position at that point after I got over the whole impact to my ego and just disappointments over deal wise not really working out or not really being the thing. Part of it was also thinking, hey, we probably could have realized this much, much earlier. And I think there were people who pointed that out to us, and we did read it initially, but we always brush on the rugs because we were like, oh, you can build a tech enabled service, and that can be venture scale as well. Because we've seen examples of tech enabled service companies raising venture capital. Even VCs we talked to didn't preclude tech enabled services from their investment criteria. So we thought, okay, so if even VCs are willing to invest in ideas like this, then it must be a good idea. But it wasn't until we actually did it, we realized, yeah, there's actually no part of this you can automate with software. Where the part that you can automate with software doesn't actually matter.
That's pretty cool. So some people had told you before. Did you go back to those people in some cases and just say, "Oh, thank you, you were right, and let's see, let's work together," or something? Or did that happen?
No, probably, if you're talking about VCs, then no, I didn't. Because at the time, we also didn't need to fundraise. In terms of like other people who told us that was more like other founders. And yeah, there's not much point going back to them, telling them, hey, you were right. But yeah, I guess they were right in the end.
If
The other
they're
part of it,
listening to this pod, Jason said you were right. So here we are.
yeah,
It's interesting what you mentioned about the ego. I believe you need some level of humility when you build a company. But even if you don't have it, most likely life and building a business is going to force humility upon you because it is tough and a very difficult way that you're a difficult path that you're taking. So it will force humility on you, but you've had it right away. It is interesting. Thank you for that. And you're right. Also, what seems like a terrible, also wanted to comment on that. It seems like a bad position to be in. And then a few days later, you realize, actually, we have this money in the bank. It's actually a good position. Again, a lesson for everyone. You listen, your situation could be bad, but it's actually probably less bad than someone else or what you might think, or there's actually probably still a lot of good things. You're, building a startup in Silicon Valley. You're still a
yeah,
YC alum. There's still a lot of good things. You could be a guy in Nigeria. Not that there's anything wrong with that, but it's a much
yeah,
better place to
it's
build a
more
company
difficult.
in
Exactly.
Silicon Valley than there, etc. Um,
Yeah. Actually, the other thing I want to say about this, if I don't know, is your audience like mostly founders?
I'm not. I wouldn't say mostly, but there's a lot of founders in there. Let's be honest with it.
Yeah. The other thing that like I constantly learn over and over again, realize over and over again, is that the most valuable thing for me before becoming a founder was actually just having a lot of founder friends. I do also know people who became founders without actually knowing anybody else who was a founder. And the struggle is just much more difficult because if you have founder friends who've been through it before you did, you get to see, especially if you have multiple friends, a pretty wide range of outcomes, how they deal with it. And it sets up your expectations correctly for when you can become a founder. I think a lot of even YC companies that end up breaking up or just shutting down for the batch, they do it because one or both of the founders didn't have the right expectations of what it would take to be a founder. I think most founders go in, and this is probably a good thing. Most founders go in expecting that they're going to succeed on day one. Then it's going to be like overnight success, even though they keep getting told it's probably not going to be that way. A lot of founders are expecting to be an overnight success. They expect to be like the exception, not the rule. But even before getting to YC, two of my closest friends were already founders, both around Series A-ish. One might be approaching Series B. And so I got to see through that process how they got there. And it was like not a straightforward path at all. And it was very difficult. And there were times when I was even thinking when I was working with my cushy full-time jobs, I don't know why this guy is still working on this startup. But it worked out. And I think seeing that and then going through YC and seeing that pattern repeat for a lot of other startups really helped me have the right expectations. So when bad things happened, I was in the right mental state to make a decisive decision about, oh, let's pivot without worrying too much about, is this the right thing to do as a founder? Because I know a lot of other founders who went through it as well. So one of my close friends, they had like pretty much diametrically opposed experiences. One went through an accelerator, was super hype, raised from like great investors, and just seemed to be like a really hot startup from the start. And the other one took about 5 years to get to that point.
Wow.
And the first couple years, maybe even the first 3 years, they just had zero revenue, zero customers. And but now I think they're both doing pretty well. And so it really goes to show that like the path towards success is not at all linear.
It's super interesting. Thank you for reminding everyone that we always hear it's a survivor bias. We always hear about the amazing startup that's doing 10 or 100 million after 2, 3 years. And everyone else thinks, oh, I'm a failure. I'm just doing 150K after 1 year, which actually is already super, super hard. The other thing that I think amplifies all of that is YC talks as well about its successes and its success rate. And once you're admitted into YC, I think a lot of people think, okay, I've made it. I'm into YC. It is so hard to get in. It's less than 1%. And so people arrive and it's okay, that's it. I'm a YC founder. That's great. Actually, around 50% of YC startups fail within the first 2 to 3 years. So there's a high cutoff and it's normal. YC is still an amazing place to invest, even with this, but probably you're right. I don't know how well YC does manage expectations because when you arrive at YC, they don't really want to tell you, by the way, half of this room is just going to fail. They want to
Yeah.
hype you up and tell you you're in the best place in the world and you're going to make it. But yeah, it actually, I haven't talked with anyone about that, but I probably should get someone on the pod and get their feelings. But it's probably a falling from very high when you realize I've made YC, but actually my startup just failed and I'm just closing shop and that's it. So also a huge difference in expectations and reality.
Yeah, I think that is pretty common. I don't know how it was in the past, but at least in our batch, YC, I'd say did a pretty good job of setting up our expectations correctly, but they were thoughtful in only doing it at the end of the batch, not at the start, because you don't want to go in and have them kind of pour water on everything. Be like, by the way, half of you are going to fail. You should be prepared for that. But at the literally at the very last meeting we had with YC, this was more of an online Zoom call, one to many kind of call. The partners gave a final presentation where they spent a lot of time emphasizing the stats and how, yeah, like a lot of companies fail within the first year. Fewer will fail in the second year, but lots still do. But the companies that make it, I think it was 2 or 3 years, have a disproportionately high chance of making it to Series A. And then once you make it to Series A, you have obviously a much higher chance of making it to Series B and so forth. And so they pretty clear that, yeah, it's going to be tough, but the priority is to just survive.
And by the way, like if you fail, it's not the end of your life. You can build another company. You can reapply to YC. There's tons of founders who go to YC several times. It's also talked about it on this pod with a few entrepreneurs. There's a lot of people who define themselves, their sense of self, their personality, their who they are by what they do. And so when your startup fails, your entire person is a failure. And that's not true. You're not what you do. You're a person, you're a son, a daughter, a husband, a wife, maybe a father, a mother, anyway. And you like tennis or soccer or whatever you do. And it's one part of who you are is your job, but it's not the entire thing. I had to go through the same thing when I built my first startup and then it failed. It was so tough on me. And then again, this is amplified by YC. You're defined by the guy or the founder team that actually made it to YC when so many others didn't. But it's good that they tell you about that. And it's true. It's about surviving those 2, 3 years. I always mention that YC companies tend to usually raise a little bit more than others, which puts them in a better position to do what you're the exact story of that pivot after 18 months, but you still have runway. That's also made possible because of YC, because you raised more. So that's another advantage of YC startup.
Exactly. Yeah, all these advantages really do compound. And so, yeah, I think that's why it's been very difficult for anybody to reproduce and build an accelerator of the same quality as Y Combinator because, yeah, they've really figured out how to layer in all these benefits and make it very difficult to reproduce.
You just from our 30-minute conversation right now, you mentioned Dalton, and you don't have many Daltons running around and giving free advice to startups. So what he told you was essential in what happened to you. And the funding we've talked about. And then you mentioned the network of entrepreneurs, even though maybe the two friends you mentioned, I don't know if they're YC founders, but then the network that you still built in YC and the support you got and the community, et cetera, et cetera. You mentioned the post from YC on LinkedIn that got you a lot of customers and early traction, even though it's the wrong company. So there's a lot of things that come into play. I wanted to go on a little tangent, but it's a topic that I love. And you mentioned the term three times, I believe, is the idea maze. I see
Yeah,
this used in YC a lot. I've heard Gary talk about it, but I'm sure a few listeners are like, "What is this ID maze he's talking about?" And I think this is a very fascinating concept. So, would you mind? Apparently, you're very familiar with it. Would you mind giving your definition, and for those who don't know, enlightening us?
sure. I guess going through YC, I saw two different kinds of companies in my batch. There were the one kind was, hey, I worked for 5 years in this industry doing this one specific thing, and now I'm going to start a startup doing that one specific thing, but better. And I'd say that's actually fairly uncommon. That was maybe like 20% of founders I encountered. The other 80% were I worked at a big tech company or some other tech company. I'm just a good engineer or a good salesperson or good whatever. I might have an idea of the general space I want to be in, but I had to find my idea just by talking to some people or brainstorming, or like some people, they just create a list of ideas by doing market research and then pick one. And surprisingly, that actually works out in some cases. And so I think I really saw that there was no one strategy for picking ideas that led to better outcomes than others. And so when we went through YC, we were in the second group because I don't actually know exactly why, but I have a theory that I think a lot of founders who have expertise in a domain, because they understand exactly how that domain works and why it's difficult, they don't want to do something there. They know what the problems are and they know it very
It's
well.
called the optimism of ignorance.
Yeah, I didn't know there was a term for it, but there you go. Yeah, the optimism of ignorance. Yeah, we definitely had a bit of that because my background was trust and safety, specifically identity and fraud. But we only briefly consider ideas there because my mindset was just, man, there's so many vendors in this space already. I've already looked at so many vendors. It's so crowded. I don't see what you could build here that there isn't already a vendor for. And so we're just like, no, let's not do that. Let's do something else. And it wasn't until we explored a few ideas that we realized that, you know what, every space actually has its problems. It's just the ones we don't understand. We don't know what the problems are. We can only see the opportunity. We can't see the risks.
Exactly.
And so we think it's super sexy. And we go there, we learn about it, and we realize, oh, actually, this is really difficult too. And so I think after a couple
So do
cycles
you
of
think
that,
this is do you think this is the maze? Is going to an industry that you don't know anything about and actually then realizing the difficulties and going back? Or is this your definition of the maze or is it something else?
I think there's two stages to the maze. There's like even picking a space to begin with. Do you want to do basically picking a customer? Right? Do you want to solve problems with the finance industry or the healthcare industry or like the for technology companies or for small businesses? Picking what space you want to be in. I think that's the first part of the maze. That's like figuring out how to buy the entrance ticket, right? So if you can't even figure out how to get you can't even figure out like which maze to go into, then like you're never going to get anywhere. You're
The
never gonna
first
get to
maze is finding the maze. Okay.
yeah, exactly. And then the maze within the maze is okay. Now you picked a space. Like, how do you get to product market fit? And even way before that, the first step is figuring out what problem do you solve. You figured out who you want to solve for, but what problem do you want to solve? And I think for different founders, I think they'll get stuck in one of those two mazes. There are some founders, and I think we were in that camp for a little bit, where they're just stuck in the first maze if you can figure out what space to focus. And I think this is very common if you have for founders we see who come from big tech, because usually when you work at a big tech company like Google or Facebook or Amazon or whatever, like you're only work on a very small piece, but bigger thing. And so you don't necessarily build up the domain expertise of this entire area. And so you tend to look for problems. And my theory is you tend to look for problems that are outside of like your domain of expertise, and you just go searching for different industries. And then the second type is, okay, a team like us, we were in this idea maze a few months ago when we first shut down DealWide, where we decided we just want to focus on the finance industry. Ideally, it's just serving financial institutions. What problems can we solve there? And then you figure out, okay, what are all the different things that banks and financial institutions have to do? Which one of those are we uniquely equipped to solve? And where the timing is actually right for products that couldn't have existed before. So I think there's actually those two different types of idea mazes, and different founders will get stuck in different ones. We have to make it through both in order to even have a shot at product market.
I want to thank you for that. I want to that thought by saying you've mentioned it briefly, but I want to double click. It's super important. Is how do you know you're actually exiting the maze? How do you know you're over the idea maze? Is product market fit. So I want to reverse that by saying to any entrepreneur listening to us, if you do not have product market fit, whether you know it or not, you're still in the maze. So it goes back to the idea of pivoting. If you don't have product market fit, but you're just banging your head against the wall with the same idea, you're probably doing it wrong. If you don't have PMF, you're in the maze. And so you need to behave like in the maze. You need to go left, up, down, try new
Yep.
things. That's how you get outside of the maze. That's how you get PMF. And that's what YC or Silicon Valley embodies, is fail fast and pivot and move on to other things. So many YC companies pivot, even within and during the batch. Obviously, today we talked about a very different story, pivoting a year and a half after. But if you don't have PMF, whether you know it or not, you're in the maze. So you should behave like in an idea maze and try several things. Okay, we are towards the end here. I wanted to ask you just a few more questions. First of all, what are you excited about the future of Finic? What's coming? What can you share, or do you want to share about we've went through the entire story of what happened. Now it's
Yeah.
going well. So just what are you excited about for the future of your startup?
Sure. I'll skip with the specifics we're working right now, because with customers we have now, we're doing something like very niche and specific that frankly is like not very exciting. It's automating disputes. And that alone is not going to be like $1 billion idea. But I think the future I'm excited about is one where financial fraud has basically been solved. And so the analogy I like to use is, you'll remember this, but some like younger people won't necessarily. But in the early 2000s, everybody was super concerned with computer viruses. Everything you downloaded, everything you did, there was always a chance your computer would get infected. People just assumed that would always be the way things were. But then sometime in like the 2010s, that just stopped being a problem. And nobody ever really like talks about it. But the computer virus problem, at least for consumers, largely, you still have like nation state actors and stuff like that. But for consumers, that's largely not something you ever have to think about. It's been decades since I got a computer virus. And it goes to show these kinds of like adversarial problems can actually be solved with good products. Another example I just recently realized is I went back to Asia, specifically to China over the holidays. I was visiting my girlfriend's family there. And the thing that I noticed almost immediately was the last time I went back to China was in 2008. Basically, anywhere you went, you had to carry your bag with you. You had to watch at all times because there were just so many pickpockets and petty thieves there. This time, there were zero. Like, it wasn't like it's not as much a problem anymore. It was like the problem does not exist anymore. Nobody steals anymore. And the reason for that is they have a massive surveillance state there. There's cameras on every corner. They have like excellent computer vision technology and facial recognition technology. And so her parents are telling me how, yeah, nobody steals anymore because nowadays, if you steal something, by the time you get home, the police are already there waiting for you because it only takes them a few minutes to look up, okay, this is what happened. This is the person. This is where they live. And they just show up there and they wait for you. And so there's like basically no risk of petty crime anymore. And so when I realized that, I was like, wow, a few years ago, I would have never thought that this is a solvable problem. But it turns out the technology is good enough and the investigation time for crimes is short enough, you can actually just create such a huge adverse incentive that nobody just does it anymore. And then I realized, well, you could probably do that for not just petty crime, but for global financial crime as well. And then today in the US, financial crime is actually on the rise. It's not going down, as what a lot of people would assume. Technology is getting better, sure, but fraudsters are going to use that same technology. And so one of the biggest challenges for banks right now is actually synthetic identities, because you can use generative AI to create entirely fake people and create accounts using
We've
that.
seen that happen more and more. Yeah.
Yeah, exactly. And so financial crime is on the rise. And the US, just in the US, just with like banks and financial institutions, they lose about 130 billion a year to fraud. And so NASDAQ did a study where they realized if you just removed all all fraud from the financial system in the US, the US GDP growth would be 40 basis points higher every single year. And so over year, that compounds like crazy. And so the thing I'm excited about, to answer your initial question, is if it's actually true that you can solve certain kinds of crime can actually be solved, you don't just make it 10% better, you actually solve it. You reduce it to 1% of what it used to be, then imagine the kind of productivity gains we'd see in the US and just globally, where people just don't have to worry about financial crime anymore. I think that's a pretty exciting future, and one where, yeah, I think if you just took all the money we use for financial crime, you put it towards like any mission or any goal you care about, like whether that's climate change, conservation, whatever. Yeah, you could imagine the good you could do with like $130 billion every single year.
Let's hope.
I think
Let's
that's
hope
a
for
part of
that.
the experience. Yeah.
I'm pretty convinced that you're going to have a big part to play in that. So I'll be following very closely. And obviously, once you've done it, once you've solved crime, I'm
I'm not
exactly with financial crime. You come back on the podcast and tell us
Yeah.
all about it. Is there a book that had a big impact on your life that you could recommend to the listeners?
That's a good question. Oh, the first one that comes to mind are two of Ray Dalio's books. Principles, obviously, that was just like a general good how to live a good life kind of book. And then the second was called, I think it was, oh yeah, Principles for a Changing World Order.
Oh yeah,
That one is also really good. More
I
on
love
like,
that one too.
yeah. And then his third one, Principles for Navigating Big Debt Crises. I wasn't as big a fan of that one. Maybe it was just like a bit too technical for me, but or maybe it just wasn't as relevant. But those first two, I think, were very
Depends
solid.
when you read it. I think Big Debt was published a second before Changing World Order. But I think at the time, which was around COVID, I think it was 2020, I read it at the time and it was super relevant. I don't think it aged well. I think you read it today. I don't know if it has
Yeah.
any value anymore, but then Changing World. Okay, so that's great. Thank you for that recommendation. If you haven't read Ray Dalio's Principles, it is a super, super interesting book. And Changing World Order is also fascinating. Again, let's see how it ages. I think already now it's the limit to read it because it's anyway.
Principle will hold up over time because there's very little that's specific in there, but the other two are very specific.
The changing world order was really about how the US could potentially be a declining impact and how China could be on the rise. But it's been like a year that nobody's really thinking that China is a threat to the US anymore. They have huge problems, internal problems. But we'll see over the long term. We'll see what happens with China and the US. All right, that was awesome. Thank you for those recommendations. Where can listeners find you if they want to reach out? If they want to follow you, what's the best place?
Yeah, I'm on LinkedIn. Just search Jason Fan Finic. I'm sure I'll show up. I'm also on Twitter, which I don't use that much, but you can find me under 001.
Perfect. All right, great. Thank you so much for being on the show and sharing your experience. I had a blast. So thank you so much for being here.
Yeah, me too. No problem. Thanks, Kate. Have a good
Awesome. And to everyone still listening, thank you for staying with us until the end. Don't forget to subscribe if you're on YouTube or rate us 5-star if you're on a podcast, Apple, Spotify. That really helps the show and drives new listeners to the podcast. Thank you once again and stay tuned for our next episode. Until next time on the Lobster Talks.